What do you think moves price action in the market from one value area to another? It's the unfilled orders of the smart money. Today I'm showing you how to take advantage of these orders and how to combine supply and demand zones with trading indicators to find the best signals. So if you could, like, subscribe to the channel and stick around for the full video. By analyzing supply and demand, you basically try to anticipate where the unfilled orders of the smart money are located in the market. The plan is to enter the market where the smart money have their unfilled orders and be a participant along with them. Knowing when the smart money liquidity providers are moving the markets is critical, so you can be there to ride along with them. So this is the mindset you must have. You enter where and when the liquidity providers, the smart money, are providing liquidity. Everything you see on the chart to the left has already taken place. The only thing that matters is where those unfilled orders are resting in the market, because that is where price action goes to and takes off from. Let us start with different methods of identifying and plotting areas of supply and demand. The easiest zone to spot is when you have an obvious change in the direction of the trend. For a supply zone, you need 2 points. First, the exact point the market dropped quickly out of a small range. I use the price open of the last bullish candle before the drop. And the second one uses the highest candle wick of the range. For a demand zone, you find the point the market rose quickly out of a small range, meaning the open price of the last bearish candle before the price increase. And the second point is the lowest candle wick of the range. In both cases, you look for a large candle body or a gap away from the zone as a future indication of how strong the price action is in that value area. The next method of identifying zones is to look for an area where price has been trading sideways and in a narrow range for several bars, and then dramatically shoots away from that range. On the left side of the chart, we see price trading in a narrow range for several bars, and then drops dramatically. The next time price came into the zone, the trend reversed, giving us a short opportunity. The third method is to look for areas of indecision, ranging periods or small corrections during a strong downtrend for a supply zone, or ranging periods or small corrections during a strong uptrend for a demand zone. These are the rally-based rally and the drop-based drop structures. The last method is by looking for gaps. When a stock gaps either up or down, there has been a sudden change in the balance of supply and demand. The price it gapped from is very likely to be a strong supply or demand zone. Watch this video if you want to learn more about market structures in supply and demand trading. When price action comes back and revisits the value area again in the future, you will be there waiting for a reaction. You must anticipate several things. Who is in control right now? How do trend waves relate to each other? Is momentum gaining or losing strength? How is the price reacting around previous highs and lows? These are important clues that will help you understand the buyer and the seller dynamics. After you identify the zone, watch for how far price action breaks into the value area on the first retracement. If price action doesn't quite reach the value area, there may be more unfilled orders left at the value area, and price could come back here to fill more orders. Very important, the first retrace back to the value area is the highest probability of a trade working out. On the second or the third retest, the probability of the trade working out decreases. A supply and demand level becomes invalid once price action breaks through and closes above or below the tested level. This is because all orders that were left at that level have been absorbed, thus the candle can close above the value area. What happens when a value area is not fresh and price has been back to it one or more times? Chances are price will trade through the value area because all of the previous orders that were placed there have been filled or absorbed. One of the most interesting aspects of trading is that there are so many different approaches. Some traders prefer to focus on supply and demand and price action, while other traders prefer to focus on technical indicators. As price action traders, we basically have two ways to trade, with or without a confirmation signal. When trading supply and demand, you have two choices: to enter when price returns to the zone, or to confirm the setup with another signal. It's important to understand that each trade and each supply and demand zone is unique. There will never be two trading situations that are exactly the same in the market. So, whether you enter on a confirmation signal or without one is going to be determined on a case-by-case basis. You might choose to wait for a confirmation signal at a supply or demand level, or you might just enter blindly at this key level. I prefer to have a confirmation from an indicator, and one of the best ways of doing this is through establishing Confluence. First confirmation comes from the MACD. A trade confluence simply refers to the overlapping of two technical elements at the same price and time point, giving the same signal. In this case, a supply or demand zone and a signal from the MACD indicator. After all, if we have two or more non-correlated signals or studies giving us a trade signal, the chances of it working are increased. Now, MACD can be used to confirm the trend's trend, direction and momentum. You can receive a lot of different signals from it. I've talked about the MACD signals in this video. For supply and demand trading, I found that MACD divergences are perfect leading signals to confirm our setups. MACD as a momentum indicator shows the movement of price over time and how strong those movements are or will be, regardless of the direction of the price moves, up or down. A divergence refers to any instance where the price reaches a new high or new low, but momentum, as illustrated by the MACD, doesn't reflect the same extreme. When price and momentum diverge, it typically indicates that the market is primed for a reversal. Here we have a demand zone on the Euro-Yen on a daily time frame. When using MACD divergences with supply and demand zones, I use a multiple time frame approach. There are two major rules for a multiple time frame analysis. Larger time frames establish and dominate the trend, and reversals start from the smaller time frames and continue upwards. So, you find your supply and demand zones on the higher time frames, the daily chart. Then you move to a lower time frame, in this case the 30-minute chart, to find the MACD entry signal. This is very important. You watch for price action to turn on a lower time frame, but at a higher time frame supply or demand area. And when trend is changing, you look at the higher time frame to see where the previous value area was, because price should go there on the lower time frame chart. On the 30-minute chart, we noticed that the MACD as a momentum indicator turned to the upside or no longer continued to follow the downward price movement. It means that the indicator diverged from the price movement and shows that the momentum of the current price movement was failing. We also had an engulfing candle rejecting the area, which is the third confluence factor in this setup. This was a valid trade and we entered right after the rejection with a stop loss below the engulfing bar. Here we have another demand zone on the pound dollar on the daily time frame. Again, we'll use a multiple time frame approach. The daily chart on the right, the larger time frame, will establish the trend, and reversals start from the smaller time frames first and continue upwards. On the 30-minute chart, here's the MACD divergence inside the demand zone, which means that momentum of the current price movement was failing. The MACD histogram turned positive, another bullish confirmation. Price then started to make higher highs and higher lows, another bullish sign. As it checked many confluence factors, an entry inside the demand area turned out to be a great trade. It goes without saying, you can replace the MACD with any other momentum indicator. If you don't like it, use the RSI instead for spotting divergences, for example. Second confirmation comes from the stochastic. Stochastic also measures the momentum of price. Although I don't rely much on overbought and oversold conditions, these signals tend to work in combination with supply and demand zones. Now, when stochastic is in overbought and oversold, it has absolutely nothing to do with the market getting ready for a reversal, not even in the slightest way. Trading with these levels without price action is a guaranteed way to lose money trading. So because I don't trust these levels much, I increased the parameters for overbought and oversold from 20 and 80 to 10 and 90, and I also increased the length of the stochastic to 15, 5 and 3. This way, the indicator won't reach the levels as often. Here we see an example of stochastic confirmation buy signal at the demand area. We'll use the same multiple timeframe approach. We'll trade in the direction of the higher timeframe. Especially for a trade like this, that would be considered against the previous downtrend leading up to it. I like to see a confirmation signal before entering. We can see a nice up move which followed this oversold stochastic signal. You could also wait for this trend line breakout if you really want to be sure that the bulls are taking full control. Here's another example. We found this supply zone on the 4-hour time frame on the right side. On the 30-minute time frame, on the first retest of the supply zone, stochastic was well over 90 and price found new sellers in this area. We had a nice swing to the downside. We even had the third and the fourth retest of the area. If you want to trade the supply area, make sure the zone is still fresh, which means that after the initial creation of the zone, price has not come back to it yet. Each time price revisits a supply zone, more and more previously unfilled orders are filled, and the level is weakened continuously. But if you have confidence that the supply area will hold, you could re-enter with a lower position. The fourth retest came with a massive move to the downside. If you learned something new, please hit the like button, since it really helps us out, and subscribe to stay up to date with our latest releases. And check out our Academy program if you want to further level up your trading. Until next time.